Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for June 9th of 2024. Getting started this week, let's talk a little bit about gold, bonds, we'll talk about investments, and then we'll kind of slide into some economic commentary here. Interesting chart from Game of Trades. We've got a plot of the gold over the long-term treasury. The TLT is basically the symbol for the 30-year treasury, long-term treasury ETF, and you can see that gold divided by that has been moving higher because we know gold has been very strong. And what's really interesting here, and I hadn't seen this relationship before, is an overlay of that ratio to the level of government spending. And obviously on different axes there, you can see that government spending in that black line approaching $4 trillion there, and then pretty tight correlation, which is really interesting. So, it seems to reason that when you have strong government spending, that you'll have a strong gold to long-term treasury ratio, that you would tend to see gold rally in those instances, which we most certainly have. Another chart here from Game of Trades. This is labor force participation and debt as a percent of GDP, and another very interesting relationship, which is in this case mostly inverse. And you can see that as our labor force participation rate has gone down, and it's something that we've actually been monitoring for quite some time. We had a rather large dislocation, as you can see here, around the pandemic, at the same time that we had a fairly stout rise in public debt, as we know, to fund the stimulus programs at all. But clearly you can see the long-term trends in labor force participation moving down at the same time that you see the public debt moving higher. And there are many little subplots here and suggestive things as we move forward. And obviously we're at a point where we had high participation and lower debt levels back at the turn of the century, and that's basically now reversed. And what are the implications of this? That you are going to have fewer workers to help pay down that debt, which could drive the risk profile of the United States sovereign debt higher. That's already been noted by some of the rating agencies, and then obviously the risk and probably the interest rates on U.S. debt likely to move higher as we move through time here. Treasury bond issuance, we know, has been really strong. We've seen that, saw that in the last chart. We see here that we're $2 trillion basically in 2024, and that follows some rather strong years of debt issuance. And we know that the debt balance, as we saw in that last chart, is pretty high, and it follows a trend of quite a few years now. Notwithstanding the pandemic year in 2020, you can see that has been rising for quite a number of years, and we had a lull after the global financial crisis, but that's clearly picked up in earnest. We have the yield curve. This is from Charlie Bolello. We have a inverted yield curve now for not quite 600 days, and that's goes back to October of 22, and so this is the longest stretch that we have ever had in an inverted yield curve. And you can see in these gray shaded bars where recession falls, and it is a long-standing axiom of finance that if you have an inverted yield curve, that was very suggestive and very foreshadowing of future recession, which we've obviously not had here. And there is some debate, with data being relatively strong, whether we might have rate increases, which obviously would help to narrow this inverted yield curve, but would also maybe have some adverse implications of its own if in fact we are in this slowdown, and a rate increase could accelerate something and put us into a recession. Something else we've been monitoring for quite a while, it's the ratio of AAA municipal bond yields relative to treasuries. And As we have noted, all across the curve and for quite some time now, that municipal bonds are trading very richly. So, in other words, you're not really getting paid nearly as much on munis, particularly in the longer durations here, but they are trading pretty richly, and in a lot of cases, it's better just to buy the taxable equivalent because you're actually just getting more net yield out of it. It's a chart from Ned Davis, and this is data goes back to 1900. It looks at the presidential cycle. I look at this stuff. I don't go to sleep, using it as a bedrock of my strategy, but it is interesting to look at how markets react during various stages of the presidential cycle. We are obviously in an election year, and so this data would tend to suggest that your best year is in the third year of a presidential cycle before you hit the election. But that usually when you have an election and that next year, at least to some degree, is reasonably good, and then you hit that plateau where markets tend to move sideways. Again, this is aggregating data over a long period of time. I think it's interesting. Again, it's not forming the basis of the current strategy, but by this chart alone, it would tend to suggest that we're going to have a relatively decent market the first half of next year. But again, there's a lot of dependencies there, and not the least of which is the pace of earnings from publicly traded firms. Rather busy chart here. This is a chart indicating the source of global international reserves, and you can see US dollars in red and gold is in the gold color, and you can see where the aggregate level of the US and gold, I guess, has been declining ever so slightly. You look at that and you say, all right, well, there's slight displacement in favor of like the euro up here, and then you've got the Chinese renminbi, which is in that real tight sliver. Of course, the Chinese are doing everything they can to try to displace the dollar as the reserve currency, and that's not likely to happen. There's all sorts of demographic issues and also economic decisions made by China that are coming to roost right now. But what's interesting here is in this sliver that encompasses gold and the dollar, that you see gold is taking on increased prominence after many years of secular decline, and obviously there's a lot of reasons for that. We got off the gold standards, and that was established at Bretton Woods, and there's a whole litany of conversation that we could have about that. But suffice it to say that we are getting the world is, leaning on gold a little bit more for a reserve store of value, and I think that has something to do with some of the strength in pricing for gold right now. Now we'll talk about stocks, and we've got we still have breadth issues in the market, and for a while we thought, okay, well, that was evening itself out, and what I mean by breadth is that you have more of the S&P 500 that's participating in the growth of the index. And right now, what we can see here is that it's still very narrow. And that's not something that we necessarily like. You've got basically the top three holdings in the index are Microsoft, Nvidia, and Apple, which now account for, just these three stocks account for 20% of the index. And you go back to the global financial crisis, and you had Microsoft and GE and Cisco here that were, maybe 12%, right? And then in the global financial crisis, you had Exxon, Walmart, and Procter and Gamble, and that was basically 10%. And so we haven't seen this kind of stratospheric influence, and again, it's been occurring over a number of years, and it wasn't just the pandemic here that accelerated this. This is happening over a period of time as the index was reconstituted, and you can see here just by its implication that the S&P 500 is becoming much more of a technology index, which is what we would always say about the NASDAQ. NASDAQ was always, very technology oriented, and so as techs went, so did the NASDAQ. Well, it's clear here that the S&P is very similar in in its influences, and you can see the deviation between like the Dow Jones, which is the industrials, versus the S&P, which is becoming much more influenced by these technology firms. A couple of charts here. This is kind of extending the conversation from the last slide, but you can see here on the very top, you've got tech sector alone comprises 31% of the index. Again, we just showed you that the top three are 20% just by themselves, and so it would seem to reason that if you add all the rest of the technology to it, then you add about another 11%. And that has changed significantly from basically around the time that I was getting into the business, and we had the 1987, market crash, and then we came out of that, and tech was not a big influence here. Although, around this time we were learning a lot about technology, the internet, the World Wide Web, and then that kind of, began to jump up here quite a bit. So, and then that obviously led to a crash when we realized that a lot of these companies weren't making money. And so what's interesting is that outside of this little dislocation period, and it was quite a dislocation, that we followed along a line of best fit here, and now we're about 31%. And core concentration within the S&P 500 is the highest in more than 40 years, and that's defined by the top 10 weights as a percent of the overall index. And we told you that the top three is 20%, but this is a pretty astounding figure. Again, in 1980, I mean, we haven't seen anything like this before. Interesting chart here. This is really more for education, but we always talk about the variability of returns and the volatility of the market, and here we have the variability of market returns in the S&P 500 that are explained by price to earnings. And so valuations we know matter matter a little bit in the near term, but sometimes markets trade on momentum, they trade on news, they trade on sentiment, but over the long haul, the valuations make all the difference in the world. And this is what this chart from Bank of America Equity Strategy here is trying to tell us, that the farther you go out on your holding period, and again, and most of the clients that we're advising are probably at least in the 8 to 12 year range. And so valuations do matter when you get into those holding periods, and obviously less so on the front end. I thought it was a very interesting chart that I think practitioners should really take hold of, because valuations absolutely matter in the long term. We have the equity risk premium. This is basically the forward 12 months earnings yield for the S&P 500 less the nominal 10-year U.S. Treasury yield, and you can see that delta, we're basically back to levels that we haven't seen since earlier this century, and now that we're over 20 years into the new century, I guess I can use that term. But this is a very interesting development. So, equity risk premium, you're not getting paid as much to hold equities because the prices are so high. Earnings yields are lower because valuations are higher, and then certainly relative to fixed income. And this is another really interesting phenomenon going on in the market now, and it really kind of tells you how much speculation is going on. We have these things called zero-day S&P options. These are basically intraday. These are, what traders use to try to make very short-term bets on the market. And again, as we just showed you, valuations matter over the long haul, but in the short term, it can be quite volatile. And so what we've seen here in the last 2 years, and I'm going to couch this by saying, first of all, that we've seen a gradual rise in these zero-day options, but again, they've been around for quite some time. They just were never really used that much until the last handful of years, and we've seen that usage go through the roof. And this is contributing to volatility, even though overall volatility is low. Okay, we have a slide here, probably requires a little bit of explanation, but we've already talked through some of these concepts. So this is from B of A Global Research, and it's essentially a comparison of the NASDAQ index versus the S&P 500. And we know that the NASDAQ represents a fairly relatively narrow swath of technology related firms in the public markets, and the S&P 500 represents a much broader percent of the overall market. And so it's interesting to look at this, look at NASDAQ in view of the S&P 500. And what we find here in going back into history is that during the tech bubble, here in this light blue line, this represents price levels of the NASDAQ relative to the S&P 500. And so obviously tech was in a bubble, and so tech valuations were really, really high. And so that got corrected. And it's interesting, we've moved in a fairly kind of linear path up here, and this is basically an increase in concentration, if you will. So, and this blue line is on a right-hand scale. So this is a ratio, and so where we are now is about 3.5, whereas before we were probably closer to 1.5. And so obviously technology has become much more important to the overall publicly traded markets, and so the dark blue line actually represents the NASDAQ earnings as a percent of the S&P 500 earnings. And again, back in the tech bubble, that was probably somewhere between 5 and 10%. Now that's somewhere close to about 40%. But what's interesting here in looking back in history is this represented a fairly large dislocation. And you can see here in this little green bubble here that's narrowed. So we don't have valuations at least reconciling the earnings side of it that are completely out of whack like we did back some 25 years ago. We have another education slide here, and this is looking at time frames from 3 years on to 20 years, and the percent of equity funds that are underperforming the S&P 1500. And so the 1500 is basically the sum of the S&P 500 that we always talk about, the S&P 600, which represents small caps, and the S&P 400, which represents mid caps. And so you can see here that that risk-adjusted returns generally have trouble finding their way to the overall level, because I think people are getting cute, and the fact that that there are clearly behavioral biases in investing, and you tend to invest, or practitioners even tend to invest, trying to chase returns sometimes, and you miss the inflection points. And again, there are a lot of novice investors out there, and this is why there is a virtue to long-term, consistent, non-bias led investing, and that's because the fact is that that a lot of equity funds just flat missed their benchmark return. So we talk about fund flows here, and this is by sector, and this is global too. So this is data from Deutsche Bank, and you can see what's interesting. As we've been talking about, this is kind of like the theme of the chart pack this week, is we've got technology, which continues to see continued inflows, although it's interesting to note that we've had a little bit of a degradation here, but that growth in tech comes at the disadvantage of a lot of these other sectors like finance, real estate, energy to some degree. We've seen telecom and utilities get a little bit of inflows here, but again, this is global, not U.S., and so we've seen a lot of disintermediation out of these names over the last year or so, and into technology. We have the S&P 500 correlation. We talk about the lack of breadth in the market that still persists to this day, and you can see that correlation amongst its members is very, very low. In fact, this is data that goes back 2018 in this time series, and that's about where we're at right now. And we do have like rolling correlations that clearly change over time, and correlation itself can be quite volatile, as you can surmise from this chart, but just overall correlation is very low at this point. We've got a couple of other interesting long-term charts, provided to us by Daily Shot. And so this represents, on this side, it's the forward earnings yield. This would be like earnings divided by the index value, or in this case, it'd be like this, the investment theme, and that sub-index. And then down here, we've got the realized volatility. And so what you want is something that comes with a high earnings yield that has low volatility. So what you want is this upper left quadrant here. And so when you look at exposures in the market, if you're geared towards wanting to minimize this volatility down here, you certainly don't want low and to the right. And so what we've seen is growth and momentum really lead the market, but it drives a lot more long-term volatility. And so if you interject like quality in here and you interject value, which again, value versus growth is a long-standing discussion, but growth comes at a much lower yield, but at higher volatility. And so it's good to have both, and it's good to be diversified. So here's your S&P 500 kind of right smack dab in the middle. And then as you get up and to the left here, which is again where you want to be, you're looking at equal weight, you're looking at thematic investments and buybacks. Dividend growth is something that we've favored for a long time, and dividend and value, dividend growth and value tend to be very correlated there. But then what's interesting here is that instead of just like going long into growth over a long period of time, you're getting the same volatility, but you're getting a much higher dividend yield if you look at small caps and you look at mid caps. And this is why having some market breadth, if there's a catalyst for these stocks to move higher, that's a real benefit to portfolios to have that level of diversification. Now we have a similar chart, but looking at different markets across the world. And so these would be foreign indices. And so again, same deal here. We've got implied volatility down on the x-axis, and we have forward earnings yields here. So what we really want is to be, up and to the left here, right? And so here's your S&P 500 relative to all of these other markets, and this is the Eurozone, UK, China's up here, so high volatility. You do get high earnings yields in China, but international dividend, we focused on that. This is Asia Pacific, ex-Japan, developed markets, ex-US, excuse me, this is ex-US, and this is small caps, and then this is emerging markets, ex-China. So emerging markets has taken on some renewed interest, as well as international dividends, for good reason, because they provide good yield at lower volatility, and it helps to diversify the volatility in the S&P 500. Now, India has been a real darling as of late, so this is, in many respects, over the long haul, where you don't want to be. It's hard to ignore India over the last year at a time where China has kind of struggled. But over time, you want to have diversification into some of these areas. So in this chart from Financial Times, so we've got a clear indication that penny stock trading is on the rise. And so this is, tends to give you a window into what small investors are doing and how speculative they are, because penny stocks, as you can imagine, as it says here, the shares that are worth less than $1. And so these are, in many cases, shares that you're not going to find on the New York Stock Exchange, because they have listing rules that prohibit, shares from being on the exchange that are priced at less than $1. So you find these in what they call the pink sheets, and this is like the over-the-counter markets. And but you've seen a real rise, just as you have in the meme stocks like GameStop and AMC and some of the others that have taken on some prominence. But this is a sign of increasing bravado on the part of small investors. You tend to have that when you have a trending market to some degree, and obviously we had a little volatility here in 2020 and 22 was a tough year as well. But you could see how we've accelerated that theme here over the last couple of years. Now we will transition over into some other economic areas. Talk first about housing. I've got a lot of different things here, but what's interesting is that we're seeing more price cuts, even as we're seeing increased home price values, but we're seeing more discounting. So people are more motivated to get these houses off the market. We do see a little bit more inventory, and I think that has something to do with this figure right here. So you can see that back in May 2021 that we had, basically, less than 9% cuts on all listings that were outstanding. And then that's moved considerably higher. So some very interesting dynamics going on in residential real estate right now. Now we'll switch our attention to commercial. Just an update here on vacancy rates, and no shock here that we've been talking about vacancy in office ever since this point, and we had the future of office kind of in question. We see that office vacancy rates continue to plow higher, and so this is going to put a lot of pressure on credit markets. We've got $1.7 trillion of commercial real estate debt that will mature between 2024 and 2026, which is 30% of the entire market, and 70% of those loans are held by small and medium-sized regional banks. And so, we do wonder where that's going to go when you have such a dramatic rise in vacancy rates. And again, this is not without precedent. So, this does happen, and that's why these markets are inherently cyclical. But the magnitude of this rise has certainly gained a lot of attention. And you can see, like in these other categories where you get like retail, and apartment and industrial, these are pretty steady. So, nothing to worry about necessarily there. We have loan counts by mortgage interest rate. This is from Arbor, but I saw this in a piece from Liz Ann Saunders at Schwab. And basically, if you add up all of these figures here, and again, you've got you basically have about 2 million mortgage borrowers that have current mortgage rates above 7%. You've got another 3.5 million mortgage borrowers that have rates that are less than 6.5%. So, the higher interest rates are still affecting a minority of borrowers, and of course, that kind of sticker shock is preventing a lot of people from selling. And so, as you would expect, there's a little bit less inventory out there, and you have that price volatility that we just highlighted to you in that in one of these preceding charts. AI is all the rave, and this is something that, just like the internet back in the late 90s, is very similar. And there were word counts and earnings calls and stuff like that everyone followed, and it was all the rave. And so, I'm not saying that with the intention of kind of dissing AI as an investment theme, because I think once artificial intelligence gets really embedded into actual business processes, and it's not just a chat GPT-4 kind of discussion, I think you're going to see some real productivity in the market, and I think you're going to see early adopters influence the people that come behind them. And so this is just an indication where the software market is expected to go. And so we're looking for by 2027 it's going to be basically a $1 trillion market, and that market is going to be up 150 to 155% from where it was back in 2022. And you can see that is that's a pretty investable theme over a horizon that's reasonable enough to build some expectations on. Got job openings continuing to slide. This is evidence of kind of some softening in the labor market, but we've needed that. This is what high interest rates will do over a long period of time. And clearly, we can see that this is a multi-year issue here, and nothing to panic about, because if you look at prior pandemic, levels, that we still have a ways to go. In the latest reading in April, we underwhelmed the expectation a little bit, but again, it's very natural and healthy to see that type of transition in an environment where you have higher interest rates and you're at the tail end of a tightening cycle. A few more charts here on labor. You've got initial jobless claims, which continue to move down. This is a sign of a strong labor market, but again, we do see job openings and hiring intentions go a little bit lower. So here we've got jobless claims moving lower, and then National Federation of Independent Business, NFIB. This represents basically small employers, and so you've got hiring intentions in this kind of this light blue aqua line here, and so hiring intentions have been real soft. They are picking up. This is basically advancing at 4 months. So this is taking data that we just got, and it's like moving it forward for 4 months as a foreshadowing of perhaps some stabilization in the market. And so then you've got private payrolls, which do tend to follow the hiring intentions on the part of small businesses. That looks like it's going to slow before it troughs and gets better. And down here, we have what's building as a very unusual circumstance, is that we have 27 consecutive months with unemployment below 4%. And you can see how rare that is. You go to these time frames, you go all the way back to 1948. And basically, we've only been at this duration of sub 4% unemployment like twice in our history. So this is very rare, and I think it means that the evolution in the labor markets are just going to take longer to play out. Talk about inflation for a second. I'd say that we do have disinflationary pressures that are at influence here. We talked a lot about inflation. I think where we are now is all of the easy disinflation has already transpired, and what's left is going to require some time. Now, we've already talked about wages, and this is unit labor costs. Here in the black line, we see unit labor costs are coming down, kind of fitting a trend line that we've seen over many decades. So that's good. Then we see core PCE inflation also coming down. And this is kind of, there's a lot of things that go into core PCE other than, other than labor per se, which can be quite volatile, but you can see this is almost being the smoother line manifestation of labor costs. But those are moving in the right direction here. And so you've got this chart from Oxford, which essentially gives you the same type feedback. So call these two very corroborating data sets here. And so you've got basically unit labor costs. This is advancing those 1 year. So it's taking unit labor costs, which we know are coming down here, advancing it 1 year, and then overlaying that against the San Francisco Fed and their measurement of cyclical PCE. And so that's moving in tandem here. So disinflation is at our doorstep, and again, because of the oddity of the pandemic and kind of the ripple effects in our economy, I think we just have to exercise increased patience on how that plays out. Here we have financial conditions that we have been talking about, and there are a lot of different financial conditions indices. This one happens to be Deutsche Bank. There's Goldman Sachs. There's Citigroup that all have these. You can see real final sales, and this is financial conditions. And on a 1 year look back, and it's also inverted here too on a year-over-year basis. And so what this tells you is, you've had real final sales to private domestic purchasers that have been relatively strong, and you can see how there is some positive correlation. It's not a real tight correlation here, but it is somewhat positive. And so to the extent that we see financial conditions continue to improve, then we should continue to see reasonable data coming out of real final sales. Now, transitioning over the right, this is something that also bears watching too, is you've got delinquencies on the rise. And this chart represents the percentage of the population that has delinquencies in their credit card debt. And you can see that, now we're approaching 15 to 20%, on that line. And this is the poorest 10% of zip codes. And so this is also an interesting study because it gives you kind of an income and wealth cohort too. So the richest 10%, obviously much lower, but you can see that all of these levels are on the rise. People, the percentage of population that has some delinquencies is on the rise. And then this down here represents the percentage of card debt overall that is delinquent. And so we also see that for all income cohorts that is moving higher too. But as we see here, as we go back to 1999 through basically 2011, that we have not achieved these peak levels yet. Now, this is something that gets our attention clearly, but it's not in the aggregate at levels that gets you super concerned at this point. We talk about the strength of the consumer, and this is a chart on excess savings, and a lot of people have calculations on this. And for a long time, we thought that we had exhausted excess savings, and a few economists came out with different ways to calculate it, which tend to suggest that we had some excess left. But and this is one of those, I guess. This is data that's collected by the Fed and the Bureau of Economic Analysis, and then synthesized by Haver. And so the aggregate or the cumulative excess has obviously been coming down. And we've been talking about this a long time as a potential future roadblock for consumption. And so, and then we see the monthly excess be negative for quite some time. And that's why this aggregate is going down, because on a monthly basis, we're not saving as much as we're spending. And so that creates that negative environment. So at some point, this will exhaust in the absence of increases in income. And so this is the theory behind, slowdown in consumer spending, which would give the Fed lots of cover then to reduce interest rates. Here we have a chart from Truist showing you a couple things here. So this is both emerging and developed market international central banks that are in the process right now of easing credit, which means that they're lowering interest rates. So they're ahead of the Fed at this. And this is the other thing that it's telling you is why the dollar is so strong right now. And it's because our rates are sticky at higher for longer, quote unquote. Fed is hesitant to reduce rates given the current macro environment, but all of the other, a lot of these other international markets, including emerging markets, are lowering their rates. And this is creating a bit of a kind of a headache for emerging markets, that especially in commodities that are priced in dollars, and those dollars are more expensive, then it creates a headwind for emerging markets that are very commodity intensive type economies. And so it is just a matter of time, I think, before the Fed actually does begin to lower rates itself. But for the time being, we're going to have this dislocation of the dollar being strong because a lot of these other foreign central banks are lowering their interest rates right now. Thought this chart was pretty interesting as we talk about China a lot. We talk about the disintermediation of commerce out of China because of a lot of things, which we won't get into here on a geopolitical sphere. But you can see the imports from China as a percent of the S&P 500 cost of goods sold. So these are basically like production costs. And the imports from China as a percent of the total S&P, you can see very, very clearly is moving down in the presence of tariffs and the presence of trade tensions and what have you. So here we have some commentary on the small and regional banks. As we mentioned a handful of slides ago, we know that the small banks are facing kind of a headwind on some of these commercial and industrial loans, and certainly those that are tied to office. But this is basically kind of a health check of the small and actually the large business banking business sector. So on the left-hand side, we've got their, I guess, agency, which would be like Fannie Mae, Freddie Mac, and treasury holdings as a percent of their total assets have been in steady decline. So they're holding other assets than these. And, when interest rates move higher, there's an inverse relationship of price and value, or excuse me, rates and value. So as rates moved really higher in 22, the value of these instruments dropped precipitously, and that's what got Silicon Valley in a real pickle. And so banks have, in response to that, kind of shifted their balance sheet to some degree. And then we look at deposits, that have really moved higher in small banks. Now we haven't seen that phenomenon in large banks. We see a lot of deposits that are that left back in 21, 22. We were talking about all of this money leaving the large banking sector because they weren't paying anything on either passbook savings or checking accounts. And so that people were taking this money and moving it into money market mutual funds that, over time, when we got to around here, we're paying like 5%. And that continues to be the case. So deposits are very sluggish on the part of large banks, but on the part of small banks, we see deposits moving really higher. So, basically what's happening here is that you've got small banks that have really worked hard to kind of shore up their balance sheet and their financial condition. So we look at credit, a quick check-in on credit, and here we've got recent declines in credit extension for the non-financial sector, and this is not something that you would typically see, if your economy is in complete expansion. So this is one of those indicators when you look at, you kind of weigh this against consumer spending, just say, hey, credit is still tight in certain sectors, and banks are still somewhat persnickety on credit ratings. So disinflation on the global sphere, we certainly have talked about it here in the U.S. That we feel like those drivers are in place. It's just going to take some time. We've also talked about how foreign central banks have been reducing rates, and this is a big reason why. So median global inflation change on a year-over-year basis is continuing to move lower, and so this is giving global central banks a lot of cover to begin to lower rates. Now, I like this chart for the perspective it gives you, dating back to the global financial crisis and what its impact was on GDP for these different areas. So here we've got Canada, Euro area, we've got the UK, and of course the United States here. And when we hit the global financial crisis, I mean, it impacted the entire world. And so, what this shows you here is that no one was exempt. But like, say, for instance, here in the U.S., we had, at least from trend line, that by the time we got to 2011, 2012, that we were about 9% below our potential GDP as it was defined, the trend lines that were defined before the global financial crisis. Well, we reset the bar there, but we continue to move higher, and then we have the pandemic. And so this is now measuring the delta between, the trend that was established here and what the reality is coming out of this pandemic, the multi-years of recovery coming out of the pandemic. You can see in the U.S. we're basically back at the trend line, and again, that's partially a byproduct of strong economy and not overly constrictive rate policy, but you can see that that is not the case elsewhere. Go to Canada, and probably more importantly, like the Euro area, they're still operating at a deficit, as is the UK. But again, the same thing happened coming out of the global financial crisis. So it's actually very impressive that we are back to trend line. But this is also a big reason why we have higher overall interest rates for longer. So on our final slide of the day, something that really caught my attention, a lot of conversation about renewable energy and renewable sources of power. And here we have now that on a global sphere, that 30% of the world's global electricity supply is coming from renewable sources. And if you go back, that's where we are now. But if you go back as recently as call it like 2011, or maybe just say, hey, 10 years ago, that number was a lot closer to 20. So in many respects, we've added a full 10% of our usable electricity supply from from renewable sources, meaning that we've displaced 10% of the conventional generation capacity with renewables. And I'd say that's a pretty interesting development. That's all we have today. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.